What a week. Copper short squeeze, gold at a record. I mean, these seem like almost secondary headlines compared to, Slovakian PM gets shot, Iran president killed in helicopter crash, DRC almost coup. And don't forget, last but not least, what geopolitical strategists, commentaries, and scholars have been fearing in the West for more than a century, a deep tie-up between China and Russia. Hello and welcome to the Northern Miner Podcast. My name is Adrian Pocobelli, and it continues here with the resources at the center of the mandala here. And it's interesting because when I was first saying that, several years ago, you weren't hearing the EU and the U.S. president talk about, metals. Now it's, I think, become abundantly clear that metals and mining are an important part of the economy. It is crucial. And it's kind of interesting, like for everything that is said about China and minerals and, maybe pollution in Indonesia, as we're going to hear, quite interestingly, with George McLeod of Access Mining in our feature content, wait till you hear this interview. It is a rock'em sock'em deep dive, very informative. I mean, we had, general topics we were going to discuss, but I deviated, and George still was able to hit the ball out of the park. So, a super fascinating interview coming up as our feature content. But before we get to that, for all of the talk around China and the supply chain and, are they being unfair? One area I think miners in general will give credit to China for, which is having the foresight in the last, let's say, 20, 25 years to see how important metals are to the economy. Frankly, it's obvious. But for whatever reason, maybe for documentaries that came out for 2 decades, lambasting the mining industry, sometimes fairly, but also sometimes unfairly. And as a result, here we are in this situation where the car industry is about to be run over in the West by Chinese auto manufacturers. And how can they do that? It is by owning the supply chain and by focusing on the beginning of the supply chain, which oftentimes are these metals and also, our cousins over there in the energy sector. Not lambasting the energy sector either. Nobody wants pollution. There are unscrupulous individuals who will put profit over pollution, who will say, I would rather make money and pollute the environment and forget everybody else. But overall, I think as an ideal, most people don't want pollution. But if we also want functioning economies and prosperity, nobody's hands are clean here. Even people at Greenpeace using their websites from their Amazon data center on their phones with minerals sourced from potentially conflict mineral zones, as the DRC has been alleging with Apple. So nobody's hands are clean here. And maybe that's a good place to start here. Again, I don't want to overly celebrate the fact, but we have to recognize the foresight that China has had in not trashing this industry for 2 decades, which is arguably what's happened in the West. And here we are. So just trying to give credit where credit is due. Now, turning to our news stories here, of course, there's a ton going on. So a fire has been lit underneath metal prices, which is only increasing this focus by policymakers on the metals. This small industry, it wasn't on the front page before. Now we're on the front page. And just to give you a sense of what is going on, Wall Street Journal, with a couple of articles, green transition set to face critical mineral shortfall, IEA says long-term investment seen as vital to avoid projected demand outpacing supply. How long have we been discussing the issue of long-term capital? How long have we been discussing it? It's been years. And why is it only now that this is becoming an issue? This isn't rocket science, right? I mean, isn't it obvious that we need metals at the beginning of the supply chain and that those have to be, developed from a defense perspective? If the West wants to be independent, don't they need to have their own rare earths, for example? So It's just kind of funny. I feel like this headline that we're reading here from the Wall Street Journal discussing a IEA, International Energy Agency report. We've been saying this here for years. And, to be fair, I'm not the only person saying this here. It's been pretty clear, I think, to most people in this industry for, near a decade that we're going to have a metal shortfall. Jeff Curry, no longer at Goldman Sachs, but now starting to do a little victory tour, victory dance, has been saying this since, I think, 2021. And here he is back on the scene, again, no longer with Goldman Sachs. And one wonders if it's because of the time it took for the copper prediction to come out. And one thing I want to mention here, as now everybody is talking about the copper shortfall, it's only a few months ago, I would say maybe a year ago, that we were getting projections that there is no problem with copper, we're fine till 2028, 2030. Remember those stories? It's easy to forget. And now here we are, less than a year later, we're hearing about, this is it. We're running out of copper. There's going to be a massive deficit. How are we going to fix this? So something else to keep in mind. Now, let's just take a closer look at this Wall Street Journal article. This is Joseph Hopp at Wall Street Journal Pro-Sustainable Business. Electric vehicles, wind turbine, and solar panel manufacturers face a shortfall in critical metals and minerals unless more investment is made in projects such as new mines and recycling, according to a report from the International Energy Agency. While market pressures eased in 2023, leading to a slump in prices for metals including copper, lithium, cobalt, and nickel, long-term investment is vital to avoid projected demand outpacing supply, according to the analysis from the IEA. The minerals are used in a number of technologies essential to the green transition. I almost hesitate to share this article with you because there's no news here, other than the fact that the Wall Street Journal is now publishing an article about what the IEA has recently discovered, that we need long-term capital if we want to foster natural resources, metals, and mining in the West. And here's a quote from IEA Executive Director Fatih Birol, who we've read about before here. Quote, secure and sustainable access to critical minerals is essential for smooth and affordable clean energy transitions. The world's appetite for technologies such as solar panels, electric cars, and batteries is growing fast, but we cannot satisfy it without reliable and expanding supplies of critical minerals, end quote. According to the analysis, the world's current projected supply of lithium will meet only 50% of global demand by 2035, while copper resources will meet just over 2/3 of demand by that time. And then we have another quote from the report. Without the strong uptake of recycling and reuse, mining capital requirements would need to be 1/3 higher, end quote. And recycling seems like a very good idea. It's interesting, I would argue, how it's not being focused on more as we have these discussions. And we do have to give credit to the IEA. In this case, they are bringing up recycling because the circular economy, as they call it, seems to be really one of the great ways that we could improve, let's say, carbon emissions while actually improving the environment. Another, what I want to call retro headline from the Wall Street Journal, May 21st, so this morning, China is winning the minerals war. Subheadline, Western efforts to make a dent are languishing. China is not just standing still waiting for us to catch up. For the past few years, the West has been trying to break China's grip on minerals that are critical for defense and green technologies. Despite their efforts, Chinese companies are becoming more dominant, not less. They are expanding operations, supercharging supply, and causing prices to drop. Their challengers can't compete. Now, this is a whole other thing, and I brought this up when everybody was panicking over nickel, which is back above $9, by the way. It was up $1 on the week. Right? And when nickel was at $7 and everybody was closing their mines, I opened the show here saying, shouldn't we be stockpiling? If they want to give away their nickel at $7 a pound, let's buy it. And really, it feels like a bureaucratic snafu that, oh, sorry, we only check, for metal stocks once a year. We actually read a story on this, by the way, that, oh, sorry, in the U.S., we check once a year, and if things look okay, what they see is $7 nickel, and they go, well, clearly we don't need to stockpile because nickel is in oversupply. That's the logic that we saw from the people that do the stockpiling for the Defense Department. And are they going to wait for $20 nickel and then say, oh, we should be stockpiling now? Finally, just on this point, skate to where the puck is going. Look at China right now. We have a story, and I'll just skip over to it before we come back to this Wall Street Journal article. China's SDIC in advanced talks for significant stake in Thai potash mine. While the West now is focused on metals as they become expensive, there's China focusing on potash, fertilizer, skating to where the puck is going. And I've heard financial analysts say, it's looking very interesting in fertilizer right now. Look at what China's doing. So back to this Wall Street Journal article on China winning the mineral war. And here is Morgan Bazilian, director of the Payne Institute at the Colorado School of Mines. Quote, China is not just standing still waiting for us to catch up. They are making investments on top of their already massive investments in all aspects of the critical minerals supply chain. End quote. The article continues, take nickel, which is needed for electric vehicle batteries. Chinese processing plants that dot the Indonesian archipelago are pumping out vast quantities of the mineral from new and expanding facilities, jolting the market. Meanwhile, Switzerland-based mining giant Glencore is suspending operations at its nickel plant in New Caledonia, a French territory, concluding it can't survive despite offers of financial help from Paris. The UK's Horizonte Minerals, whose new Brazilian mine was expected to become a major Western source, said last month that investors had bailed, citing oversupply in the market. At least 4 nickel mines in Western Australia are winding down. I mean, I just feel like the Chinese can play us like a fiddle. Like, how predictable are we? Okay, let's flood the market again. These people never learned their lesson. The Chinese are probably saying to themselves, we've been doing this for 15 years, see rare earths, and we're going to just keep doing it until they figure it out. But until then, we'll just keep playing the music and they'll dance to our tune. And here we are, in January, nickel mines shutting down left and right. And here we have a big jump in nickel. Let me just check the price. So $9.71. Now, if I go back in our informal metal pricing tabulations or tracking here, go 2 months, 3 months, if we say 4 weeks per month, 4 months, 5 months. So 10 months ago, we were around the same prices and nobody was talking about shutting down a nickel mine. We were at $9.03, $9.35, $9.48. And for the previous 3 or 4 months, it was still around the $9.50 area. It had gone up to $10.50, and then you go even further back, we're still with a 9 handle. And then it was back at 12, and then further back, 9, 8, even 7. And back then, nobody was saying nickel's going to go bankrupt. Now, if we have a 7 handle, all our mines are going to go bankrupt. Okay, fair enough, maybe price inflation, but I wonder, is $9.71 nickel enough? What about $10 if we hit that? Is that enough? And are you all going to open your nickel mines and then China's going to flood the market again and then you're going to close them up, continuing to dance to the tune? I mean, I thought it was all quite hasty, what was going on in January. Just kind of interesting. Let's go through a few headlines here before we wrap up and get to the great Sean Roosen for this week's CEO Spotlight, chairman of Osisko Development. Let's go through a few headlines. EU to call for mineral projects, eyes joint purchases. This is Reuters via mining.com. The European Commission will launch calls within days for projects to improve EU supply of critical minerals and hopes soon to begin joint EU purchases along the lines of its existing scheme for gas, a senior commissioner said on Wednesday. The EU Critical Raw Materials Act is designed to guarantee a supply of lithium, copper, and other minerals crucial for the EU's green and digital transitions to enable the bloc to produce its own electric vehicles or wind turbines and to reduce dependence on China. It enters force on May 23rd. China has been preparing for at least 20 years for this with cheaper labor than you're ever going to get in the EU and the United States. And do you really think you're going to be able to put this together in a couple of years at a price that's competitive? Just finally on this, Commissioner Vice President Maro Sefcovic said the EU executive would convene a first meeting of a board with EU members overseeing the act. Quote, Within the days after that, we would like to launch the first call for strategic projects, end quote, Sefcovic said on the sidelines of the EU Raw Materials Summit in Brussels. Processing, recycling, or mining projects deemed strategic should be able to secure permits in 15 to 27 months. Far faster than normal. So we're going into high gear here, and it's only going to take up to 27 months for you to get your permit. How many years is that? So only 2.5 years. Okay, just under 2.5 years maximum. So what's going to happen to the European auto industry in 2.5 years? And then that's just to get your permit to process and recycle or to create a mining project. Let's continue. China hints at retaliation in worsening trade clash with Europe. Food, wine, and planes could be targets, says state media post. Warning follows series of EU probes into Chinese subsidies. So basically, it sounds like the Chinese are going, well, you in the EU subsidize your food, you subsidize your wine, and maybe you subsidize your plane industry. So maybe we'll return the favor. That's what I find bizarre about this whole accusations of state subsidies. It's like, yeah, they do, but isn't this like rampant in like agriculture, at least, as far as I understand, in, places like the EU? Doesn't even Canada have all of these kind of uncompetitive aspects? What do they call it in Canada? Supply management. Interesting name. So the Chinese look like they want to return the favor. It'll be interesting to see. It doesn't seem like the EU is in a position to weather the storm perhaps as well as China or the US, interestingly. So they have to dance more delicately, we might say. Let's continue. China's $8.5 billion in steel spurs Latin America towards tariffs. A flood of cheap metal and a global turn toward protectionism is testing the otherwise symbiotic relationship. Again, the solution for so-called overproduction and flooding of cheap metal is to buy it. If Latin America really wants to fight this, get a big loan and buy the metal. I don't know why the West doesn't buy it. Just put it in a pile somewhere. Let's continue. BYD postpones plans for 2025 Chile lithium cathode plant. Chinese carmaker BYD has postponed plans to produce lithium cathodes for electric vehicle batteries in Chile by 2025, the firm's American head told Reuters on Tuesday. Chile's economic development agency, Corfo, last year said production at a new plant to be developed by BYD was expected to begin around the end of 2025, representing a $290 million investment in the world's second-largest lithium-producing country. BYD chief of America's Stella Lee said she was unsure when the company would resume its plans, citing uncertainty and complications around the project, which would make components needed for electric vehicle batteries. And here's a quote. That plan has been postponed because there is a lot of uncertainty, end quote, Lee said in an interview at a launch event in Mexico City for a hybrid electric pickup truck. She did not elaborate. So one wonders if this is because of these potential tariffs on Chinese steel that Latin America has been threatening, which is, of course, following the footsteps of the U.S. and Europe. So another just interesting development. Here's another headline. U.S. blames China's CMOC for predatory tactics behind cobalt glut. Bloomberg News via mining.com. China's CMOC group is being accused by a top U.S. official of using predatory tactics to depress prices of a key battery metal by flooding the market with cobalt from the Democratic Republic of Congo. It's not just cobalt, it's also lithium, and it's also nickel. And we have a quote from Jose Fernandez, Undersecretary for Economic Growth, Energy, and the Environment, who said, quote, what we're seeing now, I feel, is a variation of predatory pricing, end quote. And he was talking at a conference in New York sponsored by the Cobalt Institute Industry Group. And he also told Bloomberg in a separate interview, quote, in the case of cobalt, there's a company called CMOC which is driving this oversupply, and that's keeping prices down. He continues, there are consequences when you have oversupply. It's a challenge to our clean energy goals, which are going to require exponentially more cobalt going forward. So again, if there's too much cobalt on the market, I don't see why they don't just buy it. It's a very simple solution. If China and Indonesia want to provide cheap nickel and cheap cobalt, these are all EV batteries and cheap lithium, I might add. Again, let's just buy it all. So we'll get cheap metal, but prices won't go to the moon once all our miners close, and then we're completely reliant on China. It's a market solution. Isn't this what Cameco did? As far as I recall, 2 years ago, It was better for them to buy uranium off the market than to produce it. So that's what they were doing. Brilliant. And look at where Cameco is now. Continuing on, just a few more headlines. EU launches trade investigation into Chinese tinplate steel. So more trade investigations from the European Commission. And it says the European Commission has launched an investigation into flat-rolled products of iron or steel-plated or coated with tin from China to assess whether imports into the European Union are sold at excessively low prices. The Commission, which oversees trade policy in the 27-nation EU, launched the anti-dumping investigation following a complaint from European Steel Association Eurofer, the EU official journal said on Thursday. I don't even know why European steelmakers don't simply buy it off China, add 10%, and you're probably still providing it for cheaper, put everything on care and maintenance until things rise back up, which, frankly, inevitably it should. Continuing on, Aluminum Group steps up call on EU to bar imports of the Russian metal. This is Reuters via mining.com. Industry group European Aluminum has stepped up its long-running call for the European Union to expand its sanctions regime on Moscow, saying the EU could live comfortably without major Russian aluminum products. Russia's Rusal, the world's largest aluminum producer outside of China, said the main victims would be the European consumers. And Paul Voss, Director General at European Aluminum, said in a statement on Friday, quote, "It's getting harder and harder to justify the continued exclusion of aluminum ingots from the scope of EU sanctions on Russia. We could live comfortably without it, and we should." Continuing on, U.S. to offer up to $3.4 billion for nuclear fuel makers in June. Bloomberg News via mining.com. So subsidies are going out on all sides here. The U.S. plans to start soliciting bids worth as much as $3.4 billion to buy domestically produced nuclear reactor fuel as soon as next month, according to a government notice. The funding includes $2.7 billion requested by the White House as part of a broader plan to help restart the domestic nuclear fuel production industry through direct purchases of the low-enriched uranium used in reactors. And just a few more headlines here. Stellantis in talks with Vale to invest in Indonesian nickel smelter. Deal would bring rare Western investor to world's biggest producer of commodity critical to electric cars. So it looks like Stellantis wants to take a page out of BYD's playbook, which is to open a factory basically beside these smelters. And just a paragraph here. This is the Financial Times. Stellantis is in talks with Vale and China's YU Cobalt to invest in a nickel smelter in Indonesia and secure supplies of the battery metal critical to its electric vehicle expansion plans, in a deal that, if finalized, would bring a rare Western investor into Indonesia's nickel industry. Now, apparently this high-pressure acid leaching plant is very dangerous, as you're going to hear in the interview with George McLeod coming up. He goes into detail on it. It's quite fascinating. So remember this story when you're listening to that interview. And finally, just in Africa, DRC Army says it stopped attempted coup involving U.S. citizens. So this is Reuters. And so there was an attempted coup, apparently, in the DRC. With all the copper that is there, it kind of takes on an added significance. Just a couple of lines here. The leader of an attempted coup on Sunday in the Democratic Republic of Congo has been killed and some 50 people, including 3 American citizens, arrested. A spokesman for the Central African country's army told Reuters. Gunfire rang out at about 4 a.m. in the capital Kinshasa, a Reuters reporter said. Armed men attacked the presidency in the city center, according to the spokesman Sylvain Ekange. Another attack took place at the nearby home of Vital Kamerhe, a member of parliament who is tipped to become speaker. Kamerhe's spokesman Michael Moto Muhima and the Japanese ambassador said in a post on X. So, not exactly the most professional coup attempt, as George McLeod points out in our feature interview. And one more headline here. Congo demands international embargo on Rwandan mineral exports. So remember, in the last couple of weeks, Congo has filed a cease and desist order with Apple, saying that you are a party to these conflict minerals that are coming out of the eastern DRC that they're alleging Apple is buying from Rwanda. So now the Congo is demanding an international embargo on Rwandan mineral exports. This is Bloomberg News. The Democratic Republic of Congo called for an international embargo of metal exports from neighboring Rwanda, whose government it accuses of using rebel groups to steal its natural resources. All mining products from Rwanda should be considered quote-unquote blood minerals, because their sale allegedly supports conflict in eastern Congo, Mines Minister Antoinette Nsamba Kalambayi said in a May 8th statement released on Tuesday. quote, all stakeholders, including end consumers of mining products, end quote, should commit to a responsible supply chain, end quote, an embargo be decreed against Rwanda, end quote, she said. So it continues in the Eastern DRC. Coming up, I'm very pleased to welcome Osisko Development CEO and Chairman Sean Roosen to this week's CEO Spotlight, where we discuss the latest projects from a legend in the business. So very thrilled to have Sean Roosen on right now. If you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner and on Instagram at The Northern Miner and on Facebook, LinkedIn, and YouTube, where we also host these podcasts and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to Osisko Development CEO and Chairman Sean Roosen for this week's CEO Spotlight. Joining us today, I'm very pleased to welcome to this week's CEO Spotlight, Sean Roosen, CEO and Chairman of Osisko Development. Sean, it's been a while since I saw you at the Canadian Mining Symposium in London. How are you doing? How are things?
We're good, Adrian. We're knocking away on our big gold project in British Columbia and our copper gold story in Utah. So with these gold prices and the amount of intensity in the copper business, we feel like we're well positioned to bring shareholders some pretty good returns in the current market setting.
Indeed, both those metals, there is a ton of excitement around. So tell us then, for those that aren't familiar with Osisko Development, I mean, it's a well-known name in the industry. You're a well-known figure. But for those that might not have heard of the company, could you just give us a brief background on where you came from, what you guys are up to?
Sure. I'm a mining engineer by trade. I founded the Osisko Group with a couple other guys back in 2002. We started with Osisko One, which we ended up buying Canada's largest gold mine for $88,888 and put $1.2 billion into it and became Canadian Malartic, which is now the cornerstone asset for Agnico. We sold that in 2014 for $4.1 billion. We went on to found Osisko Gold Royalties the day after we sold that, which I was the CEO and chairman of, and we took that from $500 million market cap at IPO to $4.2 billion as it sits today. And my latest project is Osisko Development. You may see a trend in the name. Most of the things that myself and my partners are involved in start with Osisko. So Osisko Development is my main focus and the next company that I feel has the leg to continue the legacy of the Osisko Group with the two projects that I mentioned before. Big gold project in central BC and hunting elephants in Utah next to our friend Robert Friedland at Ivanhoe Electric and our friends from Freeport and the old Kennecott camp called Tintic.
It is quite a history that you have in this industry. And again, it's pretty well known, especially in the Canadian mining industry, for that massive Canadian Malartic deposit. So tell us what you're working on now in terms of what are the projects, go more into detail. You mentioned there's the project that's adjacent to a Robert Friedland project. Tell us what you're working on now.
So the Cariboo Gold Project located in central BC is about 16,000 hectares, 1,600 hectares, so quite a big project. It's about the same size as the Val-d'Or camp in terms of land mass. We have a resource there of about 3.454 million ounces and measured and indicated, of which 2 million is the reserve category and another 1.7 million is in the inferred. And it represents about 4% of the overall mineralized trend within that Cariboo Gold District. This is a historic mining camp. Typical of us, we usually go into brownfield camps and look for the next mine in those camps, which is the story of Canadian Malartic, which is now the 9th largest gold mine in the world and the largest one in Canada, producing over 670,000 ounces a year in a camp that everybody thought was dead. So we're doing the same. We're rinse and repeat the same thing going on in Cariboo Gold. We're located about an hour and a half south of the town of Prince George on paved road with infrastructure. We have access to clean power called BC Hydro, which is at 6.6 cents Canadian kilowatt, about 5 cents US. And this has been a mining camp since 1862. And it was the big exploration discovery after the California 49ers. And this camp has been active essentially for 150 years. We went back in with a new idea in 2016 with Eric Sprott, and then we carried on from there. We recently achieved our first EA certificate for this project in October 23. So it's the first new project in BC to get an EA certificate for 4,900 tons a day of underground production, which will generate around 200,000 ounces a year and expandable from there on to what we believe is going to be a very significant mine in the space. If we were to double that production, we would obviously be looking, somewhere in the 350 to 450 range. Obviously, that's a forward-looking statement. So treat it as such. We haven't done that work yet, but we still think that this project has the legs to get there. The next step is we're in the final process to achieve final mining and construction permits. We're hoping to have those by the end of summer. which would make the Cariboo Gold Project under Osisko Development, which is ODV on the NYC and ODV on the TSX. Make it the next project that's shovel ready in North America for a significant gold mine in a significant mining camp with significant upside. So, as we see a lot of the projects have cleared through consolidation in the space, we don't see a lot of competition to this project in terms of quality, size, and geopolitical location coming down the pipe. So we'll look to build this project in 2024, 25, and have it online hopefully 26 and 27. So it's pretty exciting for us. We're back to what we love to do, which is to build big gold mines and go back to historic camps. And we try to stay in top tier jurisdictions. Our second project is located in just outside of Provo, Utah, about an hour and a half south of Salt Lake City, and about 35 miles as the crow flies south of the Bingham copper mine that operated by Rio. And that mine has produced 57 million ounces of gold, 800 million ounces of silver, and 35 million tons of copper. We think that we have a analog potential in the porphyry test that we're doing there. This drill target has never been hit before. It's the same basic geology as the Bingham porphyry, which is one of the biggest in the world, second largest in North America. But we're at depth. We think that this one starts somewhere between 1,000 to 1,500 meters below surface. And the difference between this and Bingham is that Bingham outcropped to surface, whereas this one is still covered in sediments and in some volcanics. We're drilling our first 2 holes in there right now. We're seeing a lot of things that got us pretty excited there. The Ivanhoe Electric team is drilling to the south of us along our southwest border. So, it's always good to have Mr. Friedland and his expertise, and they're drilling off their Typhoon targets down there. But we're basically sitting in the center graben with 2 big litho caps, and this target came to us about 10 years ago. It was generated by a fellow named Dick Sillito, who's one of the godfathers of the copper porphyries. And between he and David Lowell, they've essentially been credited with about half of the discoveries in the last 50 years when it comes to big copper porphyry systems. So we're pretty happy about this. But the genesis of the project, the science is good. And it's a matter of we're playing a little bit of battleship now in terms of trying to find the right zone for the right temperature of rocks that dumped out the big metal deposit. We know there's a porphyry there. We just don't know what the grade and economics of it could or might be, assuming that it does turn out to be an economic deposit. So pretty exciting stuff there. Outside of the copper porphyry target, we also have a gold zone that we've named the Golden Rectangle, which has 5 previous producing gold mines in it that were only mined down to a depth of about 400 meters because they hit the water table, and they were supplying gold-rich silica or quartz veins direct ship to the Bingham smelter in Salt Lake City. Those mines were shut down in the 80s, but still open at depth and still significant amount of high-grade mineralization, especially in the non-quartz vein epithermal high-grade pods that we saw there. We have a resource there, a starter one, a couple 100,000 ounces right now, of which the main resource is about 20 grams. So some high-grade gold systems there with those 5 previous producers. And then we have CRD deposits, the carbon replacement deposits, that we're running about $600 to $700 worth of metal value on the base metal side. So a lot going on in this project. So we're pretty excited. We think shareholders got a good shot at, not just a big gold mine in Canada with the Cariboo Gold Project, but also the copper gold porphyry lookalike that if we were able to find even a portion of a Bingham would be a pretty big win for shareholders, as well as the high-grade gold system and the Golden Rectangle and the CRD deposits to the east of us. That's the main focus of the company. Our big belief system is gold and copper, or copper and gold, whichever way you see it. But we think that those are the 2 metals that drive the most amount of value for us in this project. And we've stayed Utah's number 2 in the Fraser Institute in terms of jurisdictions to build mines in. And our friends up in British Columbia have been great in terms of putting in a legislated timeline for permitting. And we were able to achieve our EA certificate in a 3.5-year process that they said it would take. And now we're in the final push for all the construction permits to get that rolling. So I don't think there's a better time to have a development project right now. And certainly the entry point on the stock is when you want to get in. We see a lot of the producers are starting to move, with Agnico having broke north of $100. Those producers are seeing the benefits of the gold prices. And as institutional shareholders come back down market, we should see a rally in the development stocks as we get further into this year and early next year.
Indeed, it's an incredible story once again, both projects. And so we're running short on time here, but very briefly, what do you attribute this success to? Like, is this ultimately about people and expertise? Like you were mentioning, you had a porphyry expert. Is that really how you've been able to do this repeatedly?
We're all geologists and engineers by background. We have a sprinkling of finance people, but mostly we're technical. As my line always goes, nobody ever won the Kentucky Derby, even if you're the best jockey in the world, by riding a donkey. So project selection is our number one thing in life. And then we have a pretty good technical team in terms of being able to do the science, to get through the exploration stage of it, to reinterpret like we did at Canadian Malartic. We were basically between two of Agnico's main mines when we had made that discovery. It's now over 30 million ounces, and we bought it for $88,000. So that's our MO. We go into these old mining camps, we bring new science, we do a lot of geology, a lot of structural work, and we select the right horse, and we show up at the Derby, not only with a good jockey, but with a good horse.
Amazing. It sounds like a sound strategy. So finally here, as we wrap up, you've given us a lot of information here. I mean, if you boil it down, what is your message to investors?
Stay focused on good jurisdictions. We saw what happened in Panama. Stay focused on teams that have a history of success and make sure that they're there to fight for shareholders. We've been in many battles and we've always got our shareholders paid. We hope to do that again here, and we certainly wake up every morning ready to do that, and make sure that if you got a good jockey, make sure he has a good horse.
Sean Roosen, CEO and Chairman of Osisko Development, thank you for joining us on this week's CEO Spotlight.
Thanks very much, Adrian. All the best to everybody in their investments.
And turning to the website, copper short squeeze in New York is rocking metals markets. This is Bloomberg News via mining.com. A massive dislocation between the prices for copper traded in New York and other commodity exchanges has rocked the global market for the metal and prompted a frantic dash for supplies to ship to the U.S. The source of the disruption is a short squeeze that has driven up prices on the COMEX exchange in recent days. And this article is from May 16th. The premium fetched by New York copper futures above the London Metal Exchange price has rocketed to an unprecedented level, over $1,200 per ton, compared with a typical differential of just a few dollars. So very interesting. So you could get $1,200 more per ton of copper in New York than in London because of this short squeeze. The blowout in that price spread wrong-footed major players from Chinese traders to quantitative hedge funds, some of whom are now scrambling for metal that they can deliver against expiring futures contracts. The wild swings highlight how commodity markets can spiral rapidly out of control when market participants are no longer able to finance their positions, a situation that becomes more likely amid the low inventory environment and logistical snarls that commodity traders have faced in everything from nickel to cocoa in the past few years. And we have a quote from Matthew Heap, a portfolio manager at Orion Resource Partners, the largest metals-focused fund manager. Quote, "The broader story is that there are new investment funds that are boosting their exposure to copper for a multitude of reasons. And while that's a global trend, a huge amount of that investment has been heading to COMEX. The move, according to numerous traders and brokers, was a classic short squeeze. Market participants who had placed bets on the COMEX contract moving back into line with prices on the LME and in Shanghai, the other global copper benchmark, were forced to buy those positions back as prices rose, creating a vicious cycle. The spread of more than $1,000 a ton between COMEX and London was, quote, something never seen previously, end quote, said Colin Hamilton, Managing Director for Commodities Research at BMO Capital Markets. He continues, there has been a squeeze on short positions into contract expiry, exacerbating the move, end quote. So a little bit of market chaos there on the COMEX. Another headline, Trafigura IXM caught in COMEX copper short squeeze as prices hit record. That's Reuters via mining.com. So they say it's Trafigura and IXM that were caught short there. So the following day, we get a headline from Reuters, CME boosts margins for copper future after sizzling rally to record. And this is Reuters via mining.com. The CME group will lift margin requirements for copper futures, which hit record highs this week as investors, and again, this is from last week, which hit record highs this week as investors with bearish positions were squeezed, attracting further buying by speculators. The rally that has seen CME prices jump nearly 30% so far this year would likely remain on the boil in the short term, including on the London Metal Exchange, analysts said. So a lot of drama. And then we have a column from Reuters on mining.com, and the column is by Andy Holm, a columnist for Reuters, and it says the copper rally turned ugly this week, morphing into a ferocious short squeeze on the U.S. contract operated by CME Group. CME cash copper hit a record of $5.17 a pound, or $11,414 a metric ton on Wednesday, so this is almost a week ago, amid extreme tightness in near-dated time spreads. The CME has raised margins to calm the market wildness. And scrolling down a bit, Canada's Sprott Asset Management has just filed a prospectus for a physically backed copper fund, highlighting the renewed investor interest in the metal. I wonder to myself if the authorities at a certain point, Sprott did this with uranium, right? And at some point, does the government go, look, you keep doing this and it's not helping our societies here? The fact that you can buy physical uranium, it seems to me that legislation is possibly on the way here. One would imagine policymakers are thinking. Sprott Asset Management is considering a physically backed copper fund, but can the market handle so much speculative money? Exactly. This week's event suggests Dr. Copper could be in for some very turbulent times. Can the uranium market handle that? The problem with these funds, you could argue, again, from a government point of view, is if everybody decides uranium's a great investment and then uranium goes to the moon, with all of the trillions of dollars out there, that's not a crazy scenario. And it could be all just purely speculation. So kind of interesting. Same with copper. And just scrolling down the article, and again, you can read the whole column on mining.com. If, as many analysts contend, copper is still in the foothills of a multi-year bull market, professional and retail engagement is only going to grow with every new price spike. The investment flows have only just started, and they have already upended cross-Atlantic arbitrage. It's an ominous sign of just how turbulent copper could become if too much money tries to crowd into a finite market. If I was to start getting into predictive speculation mode here, it's not crazy to think that the government at a certain point would come in and say, at least temporarily for the next 2 years, we're considering these strategic metals, and no, you can't invest in them. We're at least going to cancel Sprott's uranium fund, and we're not doing this copper fund. That is not helping us. I'm surprised they allow it, but I have a feeling it's flying under the radar, to be perfectly frank. So that is copper. And just a headline here from the Northern Miner. Billionaire-backed Cobalt, which of course has investors such as Bill Gates and Jeff Bezos, are ready to pursue the Zambia copper discovery. This is by Henry Lazenby. Cobalt Metals, a U.S.-based startup supported by high-profile investors such as Bill Gates and Jeff Bezos, is venturing into Zambia's rich copper belt. In February, it partnered with Canada's Midnight Sun Mining to explore the promising Dumwa target within the Solwezi copper project. This strategic alliance will leverage Cobalt's advanced data science techniques and Midnight Sun's extensive local experience. The goal is for Cobalt to earn a 75% stake in the Dumwa target by investing $15 million in exploration and making $500,000 in cash payments over 4.5 years. A 75% stake for $15 million. These billionaires must be laughing. No wonder they're in this business. They must just be laughing at how cheap this all is to come in and just scoop everything up. Really interesting report by Henry Lazenby on northernminer.com. And just a couple more on the metals here. Spot silver tops $30 an ounce to hit highest since 2013. So silver is above $30. LME warehouse queue returns after jump in aluminum orders. Bloomberg News via mining.com. Two huge requests to withdraw aluminum from the London Metal Exchange stockpiles have confronted the exchange with the return of an old enemy, the warehouse queue. Orders to deliver out aluminum at LME warehouses jumped by 184,000 tons on Thursday after a 100,000-ton increase the previous day. Almost all of that was in Port Klang, Malaysia, where 350,000 tons is now waiting to be delivered out. And then scrolling down a couple of paragraphs, while large quantities of metal can be placed on warrant overnight, which I believe means taken for delivery, warehouses are only compelled to deliver out a few thousand tons each day, meaning that long queues can form. And this all seems to be fallout from the Russian sanctions where Glencore and Trafigura, if I'm not mistaken, started doing some kind of arbitrage of a certain kind. Continuing on, tin prices may see further support from supply risk and rate cuts, according to analysts. This is Reuters via mining.com. Benchmark 3-month tin on the London Metal Exchange hit $36,050 a metric ton in April, propelled by production problems in Myanmar, Indonesia, and the Democratic Republic of Congo, which accounted for 43% of global tin mine production in 2023, according to the United States Geological Survey data. So you see, the tin market is reliant on 3 countries, Myanmar, Indonesia, and the DRC. It all hangs by a thread. Just one of those countries going offline, for example, if there is a coup in the DRC, you wonder. Tin has gained 31% this year, so similar to copper, making it the best performing base metal on funds flowing into the sector to hedge against inflation and as hope of rate cuts grow. Tin's gains have exceeded those of investor favorite copper. And here's a quote by Project Blue analyst Jack Anderson. Quote, while Indonesia has resumed exports, it is also uncertain whether producers in the country will increase export volumes to make up for the first 2 months of the year. End quote, he added, referring to delays in export permits from the country. Tin prices may see quote-unquote extreme increases in the second half, hitting as high as $38,000 a ton due to macroeconomic factors, said Guo Ning, a Secretary General at the China Non-Ferrous Metal Industry Association, or CNIA. And just a few paragraphs down, they have a couple of paragraphs on demand, which is quite interesting. First quarter tin consumption in top buyer China rose 6.7% to 56,000 tons, said CNIA's Guo, driven by a solid recovery in the white goods market and a slight rebound in the mobile phones and personal computers. Tin usage in the photovoltaic, automotive electronics, and chemical industries also saw good growth, Guo added. Taiwan Semiconductor Manufacturing, the world's largest contract chip maker, last month surprised the market by dialing back its expectations for chip sector growth. So also a user of tin. Now, turning over to another massive story, BHP's attempted acquisition of Anglo American. So here's the latest on that. This is Bloomberg News via mining.com. BHP debates improved Anglo bid as time runs out in takeover saga. With time running out on its $43 billion pursuit of Anglo American, BHP Group faces a critical question. What would it take to draw the smaller company to the negotiating table within the next few days? BHP's plan to partially break up and then acquire Anglo has transfixed the mining industry by pitting two of its biggest names against each other in a public tussle. Anglo has already rejected two non-binding proposals from BHP, criticizing both the valuation and complexity, and instead rushed out a dramatic restructuring plan of its own. Now all eyes are on BHP. By 5 p.m. on Wednesday, the world's biggest miner must either announce a firm intention to make an offer or walk away for 6 months under UK takeover rules. BHP is considering whether to make an improved proposal, but had yet to do so according to people familiar with the matter. The world's biggest miner would like some sign of engagement from Anglo to make a firm offer, some of the people said, and one way to achieve that would be a proposal attractive enough to convince Anglo's own investors to push the company to enter talks. Still, BHP is wary of bidding against itself in a vacuum, and walking away remains a strong possibility. The company currently has no intention of going hostile with an offer to Anglo shareholders if the board refuses to engage with it. Spokespeople for BHP and Anglo declined to comment. So in wait-and-see mode, another headline, BHP shareholders see room for one more sweetened Anglo bid. Shareholders in BHP Group and takeover target Anglo American expect the world's largest miner to come back with a third and improved proposal before a regulatory deadline next week, even after the smaller company laid out a bold restructuring plan of its own on Tuesday. Anglo shareholder LGIM supports breakup plan as BHP circles. And just the latest here on May 20th, so yesterday, Monday, this is Reuters via mining.com, Anglo-American shareholder Legal and General Investment Management supports the breakup plan announced by the company last week, it said on Monday, as the deadline approaches for BHP Group to log a formal takeover offer. The radical plan to divest Anglo's less profitable coal, nickel, diamond, and platinum businesses followed its rejection of two all-share takeover approaches from BHP, the world's biggest listed mining group, which has proposed a $43 billion deal on the condition that Anglo first spins off its South African operations. And we have a quote from Nick Stansbury, head of climate solutions at LGIM. The plan outlined by Anglo American is a radical but attractive strategy to create value for long-term investors. The execution of this plan will be challenging for management to deliver, but we are confident in their ability to do so over time. Under UK takeover rules, BHP has until Wednesday to make a binding bid for Anglo, or it will be forced to walk away for at least 6 months. If the companies find an agreement in the meantime, an extension can be granted. So really just waiting to see if a third offer comes in or a formal offer. Another headline, Macron calls state of emergency over protests in New Caledonia. This is Bloomberg News via Mining.com. President Emmanuel Macron is imposing a state of emergency in the French archipelago of New Caledonia after pro-independence protests left at least 3 dead and disrupted nickel production. The state of emergency comes into effect at 8 p.m. Central European Time and will last 12 days, the French government spokesperson Prisca Thévenot told reporters Wednesday following a cabinet meeting on the subject called by Macron. So that is last week. The measure allows the government to prohibit public protests or require the people to stay in their homes, among other actions. The most recent protests are centered on a draft constitutional change being examined by French lawmakers that would modify voting conditions in the territory. As of now, only people who have been in New Caledonia for a certain length of time are able to vote in elections, effectively excluding residents who came after 1998, even if they were born there. The draft law, which Macron supports, would change these rules. Pro-independence movements say they fear that the change would result in a loss of electoral weight for the community. French authorities mobilized police and shut airports in New Caledonia following the demonstrations. The local administration imposed curfews and banned gatherings, it said in a statement, after 130 people were arrested and 60 injured during the unrest. Another headline, deep-sea mining dust clouds travel long distances, according to research, and anybody who's seen the video of what deep-sea mining does, this vacuuming of the deep sea floor, I don't think we'll be surprised that it's creating huge plumes of dust clouds in the water. That's by a staff writer at mining.com. And finally, Brazil state asked court to double what Vale BHP should pay for dam burst. This is Reuters via mining.com. So Vale and BHP put in something like a $10 billion offer to pay for the damages for a 2015 deadly tailings dam failure. But now it looks like, according to a legal document filed on Monday, Minas Gerais and Espírito Santo states have asked the court to order Vale and BHP to pay $19.5 billion, along with interest, plus a late payment penalty. And that penalty would go back to 2015, all that interest. So no small matter there. And finally, Zimbabwe asks miners to ramp up gold output to support new currency. And that's Bloomberg News via mining.com. Zimbabwe continues to try and stabilize its currency using a gold-backed currency. So the experiment continues there in Zimbabwe. Those are your news stories. Now let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 4.44%. That is 0.04% lower than last week. The UK 10-year gilt is yielding 4.16%. That is unchanged from last week. And the Italy 10-year bond is yielding 3.8%. That is 0.06% lower than last week. So yields edging a little bit lower or unchanged in the case of the UK. Turning to precious metals, gold is trading at $2,421.70 per ounce. That is $69 higher than last week. Silver is trading at $31.88 per ounce. That is $3.20 higher than last week. Platinum is trading at $1,046.20 per ounce. That is $36 higher than last week. And palladium is also higher at $1,020 per ounce. That is $56 higher than last week. So big jump in precious metals. Turning to industrial metals, copper is trading at $5.10 per pound. That is 34 cents higher than last week. Big move in copper. Iron ore is trading at $117.02 per metric ton. That is about 9 cents higher than last week, so basically unchanged. Aluminum is trading at $1.19 per pound. That is 3 cents higher than last week. Lead is trading at $1.06 per pound. That is 4 cents higher than last week. Nickel is trading at $9.71 per pound. That is $1.01 higher than last week. So nickel with a big jump. Tin is trading at $15.54 per pound. That is 98 cents higher than last week. Cobalt is unchanged at $12.62 per pound. Lithium is lower at $14.59. That is 55 cents lower than last week, bucking the trend. Actually, uranium as well at $90.95 per pound. That is $1.35 lower than last week, also bucking the trend. And zinc continues to march higher at $1.42 per pound. That is 6 cents higher than last week. So if we go back in zinc, it did hit $2 at one point, I'm guessing about a year ago. So we have seen zinc at $2 before, but a nice march here from really $1.06 only about, 3.5 months ago, now at $1.42. So zooming out, metals not entirely, but largely moving in unison, marching higher as it looks like hot money is coming into the metals market, if I had to speculate. And here again, the standouts being copper above $5 and gold above $2,400, and those are your metal prices. Coming up, I'm very pleased to welcome George McLeod, managing partner at Access Mining, back to the program. A very fascinating discussion on Barrick and Mali, for example, many things. What is happening in the attempted coup in the DRC, what's happening in the eastern part of the country, which we've been following quite closely on this program, as well as what's happening with the Wagner group in West Africa and the Sahel, and China's alleged dumping of nickel and lithium on the global metals markets. So a fascinating discussion here. I hope you enjoy it, and I will see you on the other side. Join us today. I'm very pleased to welcome back to the show George McLeod, managing partner at Access Mining. George, welcome back.
Thank you very much, Adrian.
It's wonderful to have you. It seems like every day there is a new event of significance that is happening either geopolitically or on the metals markets almost simultaneously. Interestingly enough, copper has had quite a run here. It's a pretty important metal. It looks like it's gone parabolic above $5. What are you seeing in the copper market?
Well, I think last time we spoke, that was late last year, I said that I had high hopes for copper going into 2024. I wasn't of the view that we were going to have a recession that would weigh it down. And I think that's playing out. In terms of the parabolic, copper was basically in a holding pattern between 2020 and, let's say, April of 2024. And so the breakout we've seen is quite recent. And, if you look at it on a 2-month chart, it is parabolic. But if you scale that back to 2020, it's really been fairly flat compared to its level in 2020. So it has just broken through that $5 mark. But, I don't think on a longer term, I would see it as being overheated, I think is my point on that. It's performing well. And I think, the reason for that is for reasons I've mentioned before, which are, first of all, longer term issues, which are that, we're just not finding any of these mega mines such as the Escondida one in Chile. Obviously, we've had two larger mines, the Ivanhoe one in the DRC and then the Oyu Tolgoi one in Mongolia, which have helped to make up for declining reserves in others, but I don't think we're going to see any of those mega deposits developing in the near future. So we are running on, mines that were basically developed decades ago. And we are obviously running into a market with, huge increases in electricity demand and huge general increases in just economic demand because economies are continuing to grow. Now, the more immediate factor that I think has led to this increase recently, because those macro factors have actually been in place for quite some time. The more immediate issue, I turn on the business media and CNBC and whatnot, and there's a lot of argument about when is the time of quantitative tightening ending, when are we entering a period of lower interest rates. That discussion is over in a lot of countries, including China. The PRC cut interest rates on the 20th of February. And then recently, a few days ago, they announced a $185 billion stimulus that comes atop about nearly $800 billion in industrial stimulus that was announced earlier this year. So this is, arguably the biggest stimulus package that China has ever introduced, depending on how you crunch the numbers. But either way, this is going to have a huge impact on copper demand for different reasons than in previous stimulus. Previous stimulus benefited the property sector. This one looks more to be aimed at the industrial sector. Either way, it's hugely positive for copper. And is it parabolic? Is it overheated at this point? I mean, it could have a slight pullback or flattening in the immediate term, but I don't see there being anything that's really going to knock it back to its 2020 to 2024 doldrums that we just got out of.
Okay, very interesting. So you see it as mostly, you might say, a supply-demand story, Chinese stimulus really kind of pouring gas on the fire, so to speak, of demand. So then how do you see the certainty then of the current supply? I don't know if you saw that story that came out, what looked like an attempted coup in the DRC there. Did you see that story?
I saw it. There's a lot going on. We've had the Iran issue with the helicopter crash. We've had the DRC attempted coup. With the DRC issue, I haven't looked into it beyond what I've seen in the headlines. It's obviously a country that has huge political instability issues. I wrote an article on my Substack about that in January, that any mining company that's operating there is just really having to deal with a plethora of political issues. There are, I would call them not mercenaries, but kind of mercenary-ish political figures in the world that do this type of thing, that are active in Myanmar and in Laos and in the DRC and Central African Republic. And so it looks like that was what was going on there in that abortive coup d'etat, which obviously wasn't a very well organized coup d'etat. But I don't think that's really going to change anything in either a positive or a negative way in the DRC.
Interesting. So just to drill down a tiny bit on that, are you ultimately saying that theoretically, and of course this is all pure speculation, but perhaps this is a non-governmental entity to a certain degree, one of these kind of quote unquote groups?
From my experience, I actually know a few people that are this type of person, sort of these ex-military, quasi-connected to intelligence services, but not really part of the intelligence services, with very strong political views, very fired up, who, as I say, are active in places like Myanmar, Ukraine, very big center right now for this type of thing, Ukraine, Central African Republic, DRC, and they get enlisted by various political figures. And occasionally, you've seen bizarre issues like this one come to the fore with, an attempted coup. I wouldn't necessarily read too much into this in terms of it being a game changer in the DRC. I do see it more as the type of, ongoing instability that is prevalent in that country. I mean, this is a country where large swathes outside of the capital are controlled by rebel groups. There's, any given day, there's huge fighting around various parts of the border regions. So the fact that there was this attempted push, I think, is just sort of part of the political noise that goes on in the DRC.
Almost par for the course, perhaps.
Right.
And just while we're on the DRC, I'm sure you've been following all the events that are happening in the East DRC. It sounds like this conflict goes back to the 90s in some respects, from just what I read, and that there's a lot of coltan deposits that seem to be sought after. Do you have any thoughts just on the Eastern DRC and this whole M23 conflict that's going on over there?
Yeah, I mean, again, this is not a new conflict, and it's not one that is going to go away anytime soon. There are a lot of forces operating there. There's Russian forces, there's regional forces from other African countries. And, in terms of will it threaten Western mining interests, it doesn't seem, this is, quite far away, quite isolated from where companies like Ivanhoe are operating. And these are very different types of mines than what you would, typically cover at the Northern Miner. These are very, how can I say, low technology, very local.
Artisanal, perhaps.
Correct. Yeah. So I don't really compare that to what's would be taking place with Ivanhoe, for example. But the instability there continues. It doesn't get any better. There are attacks all the time, and this has also supported the Wagner Group's sort of increasing influence and presence in the region, in particular in Mali, which is one country that I've been looking fairly closely at because of its outsized role in mining as well.
Well, let's go there then. Of course, West Africa is a whole other, kettle of fish, which brings us to another major metal, gold. I remember talking to the CEO, Jorge Ganoza of Fortuna Silver, and he was telling me in an interview that, if you get rid of the borders in West Africa, this is, arguably the richest area for gold in the world. And so what are you seeing in Mali? What is your take? I mean, we've seen Wagner making headlines. We have the Barrick story, right? What's your take on what's going on?
Yeah, so I mean, Mali has obviously serious political problems there. I remember when I was in Senegal in 2020, I was going to go there over land, and people said, oh, it's, you should go. It's great. It's interesting. And then I didn't go, I think, because of the COVID restrictions. And then the next year, when I was there, I was planning a similar trip, and the response was, you're nuts. You can't go over land to Mali. So the situation security-wise has changed a lot. And this goes back in a more general sense. These countries in the Sahel region have been severely destabilized following the fall of Gaddafi. There's a lot of jihadist groups active there. And so a Western military presence was keeping those at bay for a while, led by the French. And in 2022, that mission ended following a coup d'etat in Mali. So basically, when you mention the controversies around Barrick, also around B2 Gold and IM Gold, which are active in Mali, Mali has a lot of gold, mostly on the border of Senegal in the south. So one of the issues was back in December of last year, a group called Blood Gold released a report that basically accused Barrick and as well as IM Gold and B2 Gold of financing what they deemed to be a pro-Russia junta in Mali. They also gave a very long and I think pretty good description of how the Wagner Group was operating as a sort of a, pseudo-official military outfit in rural areas of Mali. They were going into villages, killing people, acting as a sort of a secondary force for the Malian military. And it came to the conclusion that Barrick and these two other companies were basically party to the Ukraine war, because they were engaged in Mali and they were paying taxes to the government. So the report got a lot of media play, and I read it very carefully, and I actually didn't find the findings to be that compelling. It seemed to really only dwell on the finding from Barrick's own materials that they were paying about $230 million a year in taxes. I don't consider that to be a particularly compelling finding. I mean, if anything, companies are usually more culpable if they're not paying taxes, because that suggests they're, bribing the government. So paying taxes to the Mali government, I didn't see that to be a particularly strong finding. I had expected that they might have come up with secret accounts or bribes or something along the lines of investigative agencies like, say, Global Witness, which are, you don't want to have a Global Witness report written about you. So I found the Blood Gold report to be not especially interesting in terms of the findings it reached. The other thing is that I'm not entirely convinced with the narrative that the Mali junta is quote unquote pro-Russian. I mean, they certainly have strengthened ties with Russia, but the junta leader, a guy named Assimi Goïta, he actually is quite close to the States. He was trained in the United States. And, he seems to be playing both sides. Two of his cabinet ministers are very pro-Russian. But aside from meeting with Putin and various trade agreements, which themselves aren't that large, I'm not sure I would subscribe to the view that Mali is so-called pro-Russia administration, as this report would have us believe. Having the Wagner Group operating in Mali is obviously a very big step. But that's is much to do with the fact that the Mali armed forces just aren't able to meet this threat of these jihadist groups. And keep in mind that the Russian position on these jihadist groups is basically the same as the Western position. The Wagner group and the Russian forces are doing the same thing that the West was doing there as well. So whether it's the French or the Wagner group doing that, it's a similar goal. I mean, Russia obviously was hit by that terrorist attack, and they're very keen to fight these jihadist groups. So I think that it's a little bit more nuanced than this just being a sort of a pro-Russian state like Belarus, for example.
Interesting. And as far as the mine that they're discussing, the Loulo-Gounkoto mine, and I assume you saw that report, I think it was the Africa report that had this kind of sensational take that the Wagner group wanted a soft takeover. And then, of course, that got in the Globe and Mail maybe 2 months later, kind of through another article, interestingly. Do you have any thoughts on that? Like, I guess you heard the Barrick call where it sounds like Mark Bristow doesn't really, in a sense, he doesn't know much more than we do, it sounds like to me.
Okay, so basically what the suggestion was there was that because Wagner Group has taken over 3 mines in Mali, and is now essentially guarding them, and as the article suggests, operating them. That could lead to the Wagner Group essentially expropriating Barrick's mine. Now, we have to realize that these quote-unquote mines that Wagner Group has seized, they're not like Barrick mines. I mean, they're basically, artisanal mines, which is a polite way of saying, villagers in flip-flops and pans. I mean, this is not in any way comparable to what Barrick has. So, and Wagner Group's role there is basically preventing the jihadists and other rebel groups from, taking over those mines, extracting taxes, and using them as a funding source. It's not operating them. It's obviously getting taxes from them and making money, but it's not a multinational mining company. So to suggest that because they are guarding them, a presence there, whatever you want to call it, that they're now going to make a move on Barrick, I don't think that's going to happen. I don't think there's any validity to those suggestions. I can see a scenario where, possibly an outside force like a Chinese mining company could maybe come in and make a backroom deal with the Mali junta and make a move on Western mines there, but that's more of a general risk factor. I see the risk of Wagner Group expropriating IAM Gold or B2 Gold or Barrick's mines in Mali as very close to zero, frankly.
That's fascinating. When you describe everything, and the difference between the artisanal mines and these kind of high-tech 21st century multinational, like it does kind of spell out like Mark Bristow's probably argument to the Mali government. Like apparently in the conference call, he said he did confront the government with these rumors. And it sounds like he can easily say, like, you're not going to be able to do what we can do. So you're, in a sense, with the inference being don't kill the golden goose, so to speak, because you're not going to get the same results if you, expropriate.
Well, exactly. And in a way, the Blood Gold report and this Africa report are arguing opposite things. Because how on one hand can Barrick be in league with the junta, but then on the other hand be having their asset expropriated? The same reasons that people say that the mines would get expropriated are the same reasons why they wouldn't, i.e. they are basically keeping that government going through their tax payments. Again, I could see some unforeseen issue challenging their status there, but the things that have been put on the table in those 2 reports, I think are frankly verging on ridiculous. This isn't coming from somebody that, is overly positive about the security of doing business in Mali. I think it is a very high risk country. And I think that, mining companies have essentially been driven to deal in these high risk jurisdictions because they just can't get operations going in the West. And I also think that this is an example of, I think that there's going to be a lot more of this type of thing facing mining companies as commodity prices rise. They're going to see more scrutiny from NGOs. They're going to see themselves caught in the crosshairs of geopolitical disputes. They're going to see accusations that they're quote unquote in league with China or in league with Russia if they're operating in countries that are perceived to be leaning towards either of those powers. And frankly, I don't think they're ready for that right now. I don't think they have the lobbying power, the PR power, the government relations power that other industries like the oil industry or even the tech industry have in terms of fending off these types of issues.
That's a fascinating take because you could argue First Quantum in Panama. You could argue that perhaps it was partly, a PR failure. It was a PR failure. And to your point, maybe there wasn't that kind of, lobbying, that expertise that knew how to kind of deal with the government in a way that maybe the oil industry, to your point, is used to.
Yeah, correct. You got to remember that these mining companies are coming out of essentially a mining recession that lasted from 2012 to 2020, even a mining depression, and then followed by stagnation that occurred amidst highly inflationary cost structure for their production. So they've really pared back their spending. Anything that is not a core operational expense has been cut. If you're an engineer, you still work there. If you're in communications or government relations, it's very, very slim departments there. So compared to what other industries that are in these politically sensitive areas would devote to those types of soft requirements, the mining industry is non-existent. And I think that they're really, as I say, going to come into the spotlight in the coming years as gold prices and base metal prices increase and as governments start increasingly to see these metals as being national property rather than privately owned.
Indeed. Yeah, beautifully put. And so zooming out then, we started with copper and then zoomed in to the situation, say, in Africa. What are you seeing with gold right now? The general narrative seems to be that China is ultimately buying more gold. Their central bank has been buying higher amounts than normal. And then, you go down the range of, gold bug narratives, diversifying from U.S. treasuries, right? As you go down the spectrum of story. What are you seeing in the gold market? What's driving this move?
Yeah, on our last discussion, I said I expect 2024 to be very, very strong for gold. And, that's playing out. We broke out of those doldrums of gold trading between the low 1800s and the high 1900s that persisted between 2020 and 24, which made it, as I said before, probably the most stable asset class of any during that time. The breakout has been about 20%, which, as I say with copper, on the short term looks parabolic, but I think if you stretch that chart out, it doesn't look parabolic at all. In fact, it's fairly subdued, I would say. And it does come back to the rate cuts that were announced in the PRC. It's no coincidence that the gold breakout occurred just 5 working days after the PBOC's announcement of the rate cut. And if you looked at the way that gold was trading, it would trade up in the Asian markets. And then as Europe and the US opened up, it would kind of drop back. And a lot of that, according to the statistics, the figures that we've seen, was back down to the PBOC buying. I think the figure was $17.5 billion, which in the physical market is money. It's very difficult for the physical market to meet that demand. So I wasn't surprised that it went up, but actually one thing I was a bit surprised at was that it looks like the PBOC was effectively chasing gold up, which is very unusual for a central bank. Central banks don't usually momentum buy. So I was a little bit surprised by that. It looks more recently like there's some demand kicking in from ETFs in the US, which is what drove gold prices up in 2020. So possibly we could see more demand coming in from the investment side. Personally, if I was to make a bullish case, I would struggle to make that bullish case purely on the basis of central banks. I don't think that that is a sustainable way for the gold market to continue on its upward trajectory. But if we do see more buying coming in from ETFs and from the investment sector, I think that that could cause this rally to continue.
Okay, excellent. And just as we wrap up, then it would be great if we could cover a little bit, speaking of China, of what's going on with the lithium and the nickel markets. Of course, we have this really interesting situation I find with, BYD and, it seems like China owns the supply chain to a large degree, which gives them this inherent advantage in producing, for example, electric cars at a far lower price. Nevertheless, nickel has taken a hit. It's recovered a little bit. Lithium is quite low compared to where it was, maybe a year and a half ago. What are you seeing with this kind of Chinese EV battery metals story?
Yeah, so I think the way you frame it is good. When I read the media coverage on nickel prices, it tends to be framed as being Indonesia is exporting nickel and it's driving down the nickel price. That is true. It is Indonesia, but basically what happened was that China started using a type of technology called high pressure acid leaching, which is a technology that was developed in Cuba in the 1960s. And it involves getting nickel ore, putting it in a cylinder, and then injecting, pressurized hydrochloric acid into that ore. And it, processes it into the nickel. It's a technique that was abandoned because it's very dangerous. It essentially, you're basically creating an acid bomb, one of which exploded around Christmas and killed about 50 people in Indonesia. It's also incredibly polluting, but it allows the processing of nickel laterite, which is a lower grade type of ore that's largely dismissed as being uneconomic. So what Chinese companies are doing in Indonesia is they're using this technique, which they shouldn't be using, and they're bombarding the nickel market with this nickel, and it's driven the price down. I think that a lot of this has to do with China's stimulus strategy. One of the ways that they're diversifying their foreign currency holdings is by funneling them through SOEs and quasi-SOEs. And so these mining companies operating in Indonesia are getting a lot of help from the Chinese government, which is allowing them to dump this product on the market without much regard at all for whether it's profitable or not. That's why I don't entirely agree with analysts who say that this is a buying opportunity. Obviously, as you note, it has recovered somewhat, but we need to have a more complete story of what China has in mind in terms of, as I say, dumping on the market without any regard for the profitability of nickel. I'm curious as to whether they'll try to adapt this technology to copper. I haven't seen any evidence they will. In terms of lithium, lithium's absolutely been, obliterated by the use of lower grade lithium product in the PRC. They're not needing to do it outside of China. They're doing it in China. It's, again, very polluting. And lithium, I think, is even more vulnerable to this type of price dumping because it is so common. Lithium is pretty much everywhere in the world. So unless some sort of political pressure can be exerted, I'm not sure how this long-term dumping issue with respect to the nickel and lithium market can be addressed.
Okay, excellent. And just as a final question, then, I'm asking you to speculate here, but what do you think China's motivation is here as far as, dumping nickel and lithium on the market, not worrying even if it's profitable? It seems to me this is kind of a rehash of what we saw with the rare earths market, say in 2010 and maybe even previously, where it seems like a play to kind of own the market, so to speak. What do you think of that?
Absolutely. There's a few goals. One is simply stimulus. Another is driving Western competitors out of business, because if Western mines are out of business, it's very difficult for them to get back in business. Another is monopolizing the EV market. I've said for a long time that I think that the West is probably making a mistake going so heavily into EVs, because this is just not a market that the West is going to be particularly successful at, especially with this, as I say, dumping of EVs, dumping of nickel, dumping of lithium. Probably, what the West is going to have to do is focus more on hybrids because we have oil. China doesn't. But either way, their goals are geopolitical. They're for stimulus aims, which I've mentioned before. And I don't know how that can be addressed through market forces. I think that if it is addressed, it'll be through political pressure. There are avenues to pressure Indonesia under the new administration of Prabowo, who's quite pro-Western. He was trained in Hawaii. But I'm struggling to see a case for how this could be a market-based buying opportunity for nickel and lithium when these commodities are not really being driven by market forces.
George McLeod, managing partner at Access Mining, thank you for joining us and sharing your very interesting insights on this week's Northern Miner podcast.
Thank you very much.
Once again to Osisko Development for sponsoring this week's episode of the Northern Miner podcast. And also thank you again to George McLeod for a fascinating discussion on many topical issues that are happening in the mining industry, including the massive moves in copper and gold. If you like the program, please leave us a review in the Apple Podcast directory, share it with your friends, and until next week, take care.